Students, welcome you all once again in the last lecture of Ind-AS 37. So in the previous lecture, we have started this Ind-AS 37 and this standard talks about provisions, contingent liability and contingent assets, right? In last class, we have understood why this standard was required and what is meant by provision, right? If you are saying that we are taking a provision for telephone expenses, electricity expenses, right? We are taking a provision of, let's say, audit fee. Actually, these are not provision. Why? As far as the meaning is concerned, provision is a liability of uncertain timing or amount, right? So in all these cases, there is no uncertainty relating to timing or amount. If you are using your telephone, right? So you are creating your accrued expenses, right? Because you know that you are using that telephone, and you know that if my bill is 500 rupees, right? So it has to become as a 500 rupees. You know that if my per unit electricity expenses is, let's say, 5 rupees, and I have already consumed 2000 units, so I have to end up paying 10,000 rupees, right? Audit fee, it is actually certain. Audit fee is already agreed, right? So there is no uncertainty relating to the period, because you are aware that this audit fee has to be paid for FY, let's say 21-22. Okay. So actually, we are calling it as a provision in our normal language, in our layman language, but these are actually not a provision, right? What is a provision? Provision is a liability of uncertain timing or amount. For example, provision for gratuity, right? For example, provision for gratuity, provision for leave encashment in future. Okay. So provision for asset retirement obligation, provision for warranties, provision for environmental related provision, right? Environmental related provision. Like Hindalco Industries Limited in its balance sheet has also created an environmental related provision. Normally, the companies which are into where I would say, like nuclear companies, nuclear plants, like your acid factories, like your plant where carbon emission are much more, right? So they are investing, they are obligated to they are obligated to incur some expenses to clean up the environment, right? So environmental related provision related to legal claims. So these are covered under the provision standard. Okay. So then we have discussed about contingent liability and contingent asset. So friends, in the last class, we talked about some definitions, like definition of a liability, definition of a provision, definition of a contingent liability, definition of a contingent asset, right? Then we have talked about the recognition and measurement. So when a item is required as a provision, so an item is required as a provision when three conditions will be satisfied. What are the three conditions? The three conditions were, what are the three conditions? The three conditions were, there should be a present obligation, there should be a present obligation due to a past event, and past event could be a legal by virtue of a legal obligation or by virtue of a constructive obligation, right? So there should be a present obligation. The outflow of resources is probable. Probable means more likely than not, right? And obligation can be estimated reliably. So you can just think about these three items. Present obligation. If there is a present obligation, then only you will create a provision in the present date, right? In the reporting date. So there should be a present obligation. This present obligation could be a legal obligation or could be a constructive obligation. This present obligation could be a legal obligation or could be a constructive obligation. And this obligation should arise out of a past event. This should arise out of a past event. Means in the past you have done some event, and that is why this present obligation has been arisen. For example, the manufacturing plant, if they have emitted a certain level of carbon emission, they are obligated to make the environment good, and that is why they have to create an environmental related provision, right? So it could be by way of a legal obligation because of the environmental law, or it could be due to the published policies, past practices, right? And the second one is outflow of economic benefit is probable. Again, it is not certain. If it would be certain, it should not be a provision, right? So outflow of economic benefit is probable, means it is more likely than not that the companies end up paying some amount, or the entities end up paying some resources in terms of resources. Third, obligation can be estimated reliably. Obligation can be estimated reliably. So again, it is talking about estimate, since it is something which is not certain, and that is why estimate has to be taken. And we have taken an example of asset retirement obligation, right? In India 16, you also have learned that when you are installing any asset or a factory or a power or a property plant and equipment, so the dismantling cost, asset retirement obligation has to be added to the cost of the asset, right? So why? Since you have installed a plant, and due to installation of a plant, there is an obligation to restore that premises or dismantle that premises after a certain period, for example 20 years, 30 years. But since the amount is not certain, how will you know that after 20 years what should be my restoration cost, what should be my dismantling cost? How would you be able to know? And that is why, so present obligation is there. Why? What is the past event? Because you have installed a plant in the leasehold premises, and you have to dismantle it after 20 years. You have to restore the land after 20 years, right? So present obligation due to past event is there. If it is contractual, it is a legal obligation, right? And you are aware that yes, I am end up paying some X amount, right? But you have to estimate the X amount. So how will you estimate the X amount? For example, if I will restore the same plant today, it is costing me rupees 1 lakh. So if my obligation will arise, my outflow, I'm not talking about obligation, my outflow will arise after 20 years, and the inflation rate is, let's say, 6 to 7%. So what should be the inflated cost after 20 years, right? So it will come out at a future cost. Then you will discount this future cost to the present value. It will give you a provision which has to be recognized in the books of accounts, right? So we talked about this provision. We talked about the legal obligation and constructive obligation. Constructive obligation arises out of the established pattern of past practices, published policies, commitment, etc., etc., right? So then we have done some case study. Okay. So these case studies, then we talked about the probable, which is more likely than not. And to understand this concept, I have also covered this case study. Then we talked about the constructive obligation, and we have also discussed a case study on constructive obligation, right? Then we talked about the contingent liability. Contingent liability is a possible obligation arising from a past event, but the liability will confirm upon happening or non-happening of some future event, right? Or if any of the condition of provision is not meeting, for example, present obligation is there, but either outflow is not probable, it is possible, means less than up to 50%, basically more than 5% up to 50%, or outflow is not measurable. In that case, it has to be disclosed as a contingent liability, right? Then we have discussed about contingent assets. So contingent asset is a possible asset arising from a past event to be confirmed by future events not wholly within the control of the entity, right? So contingent asset is something, if, so basically we are talking about an asset if a company has filed a litigation against a vendor or a customer for some recovery, right? And if the entity is virtually certain that it will become your asset, but if the entity is probable, more than 50% chances is there, yes, I will be able to recover this money. In that case, it has to be a contingent asset and it is required to be disclosed. So this we have discussed. Okay. Then the present value part, we have discussed that if the time value of money is material, the provision has to be recognized at present value, right? Present value means discounted value. This part we have discussed, and on the Excel file, I have shown you the entire calculation of 50 years for asset retirement obligation. And one of the case study we have discussed for this 1 lakh 10 lakh rupees of provision, right? 6% rate, 10 lakh rupees of provision. This entry, this treatment we have also discussed in the last class. Let me look at the query box. If there is any query, I would discuss that. Otherwise, I'll move on. Yeah, once again, very good morning, Sumit, Koshiki, Rashmi, Rahul, Pooja. Very good morning to all of you. I hope you guys are able to have a quick revision of the last class? Yeah. I move forward. Okay. Yes, friends. Hence, as I told you that provision is a liability of uncertain timing or amount. If something where the timing or amount is uncertain, then the question arises, sir, how to measure that provision, right? How to measure that provision? The important question is how to measure that provision. And in this case, the provision is nothing, it should be a best estimate. It should be a best estimate. Now you tell me, for example, in case of electronic companies like Samsung, LG, right? Dyson, these companies are selling electronic products with warranty, right? And they are selling in bulk. So basically, it's not like three quantity or four quantity or five items. In a particular year, in a financial year, they are selling, let's say, 10,000 unit of item, okay, across India. And they are selling it with the warranty, right? They are selling with warranty, 1 year warranty. So how will they estimate, since they have already sold a product, right? They got the money, they booked the revenue. Now they have to incur some cost in future, let's say up to 1 year from the date of sale. Since they got the money in this year itself, and in the future year, whenever they will entertain the customer on account of warranty or guarantee, their outflow will be there, right? But they will not be able to recover any money from the customer. Now the question arises, present obligation is there? Of course, yes. What is the past event? Sale of product with warranty is the past event. Present obligation is there. If the customer will come, they have to entertain it, right? Is there any legal event or constructive event? Of course, legal event is there because it has been sold with a warranty up to 1 year, right? Now the question arises that whether outflow is probable. Answer is yes, because as per the past pattern, company knows that if the customer will come, we have to pay him. I mean to say, we have to get it repaired and return it back to the customer. Whether outflow is measurable. So again, outflow, I mean to say that provision has to be calculated on the basis of best estimate. Now the question arises, how will you calculate the best estimate? Tell me, how will you calculate the best estimate? What is in your mind? Generally or practically, how the companies are doing? Generally, the companies are creating the provision on the best estimate, and the best estimate is on the basis of the past precedent, right? For example, these companies are very old companies, right? And this company knows that in the last years, generally our repair cost or under the warranty, our cost incurred to the extent of, let's say, 5% of the sales. For example, if I am selling goods worth rupees 1,000 crores, so close to 50 crores comes to me as a repair, as a warranty, under warranty, come to me as a repair. Okay. So friends, in this particular case, of course, we are talking about the past precedent, right? Because of the industry, because of the company's experience with the customers, we are talking about the past experience. If the company is new, then we should talk about the industry experience. What is normally, what is the warranty or sorry, what is the warranty cost which is going to be incurred with our competitors, right? So in your examination, you guys are not required to calculate that how this probability or how this percentage has to be there. It will be given. It will not be given probably in a right plain vanilla English language. Probably, I mean English language, I mean to say in a plain sentence, probably it is given that the company is a new company, but the company has the company has got the valuation done, and the valuers have told that normally in this industry with this product, normally whatever the industry sells, 5 to 6% comes out as a warranty, 5% comes out as a warranty, right? So in that case, you have to take a 5% number for calculating the provision, right? But how the companies are doing? Yes, the companies are doing in this manner also. They are taking the past data for 3 years or 5 years, because larger the period will be there. larger the population will be there, your estimate will be the most accurate, close to accurate, right? Because you can say now, probably in the last 1 year, for example, in the last 1 year, you will say that no warranty came to me, or it was very minuscule. Probably it was the COVID year, right? People were not able to, get it replaced or get it repaired. So you have to increase the horizon to get the most accurate number. But the moral of the story is how this best estimate has to be arised. The best estimate has to be arised by looking at the past precedent. Second, for example, if it is environmental related, provision, again, I'm talking about the carbon emission and all, right? If it is environmental related provision, the company is saying that normally we are investing, let's say, 10 crore every year for cleaning up the environment because of this air pollution created by our chimneys. Okay, created by our chimneys. Now the question arises, what should be the best estimate in this case? Again, the best estimate should be whatever you are incurring into the past, or whatever could be the estimated cost of expenditure to clean up the environment, right? Third, provision for legal claims. Now, what could be the provision for legal claims? Okay, for example, your customer has filed a suit in a company. Your customer has filed a suit against you in the court of law. So the customer has filed a suit for compensation of 1 crore rupees, let's say, right? Because in India, you know what people are doing. So I have seen, because I work with a listed company, with a large listed company, what people are doing, if there is a small vendor, right? And the small vendor with whom, let's say, the company is having a dealing of, let's say, 10 lakh rupees. But if everything goes wrong, or if everything happened, so if the vendor goes to the court of law, the vendor will initiate a demand of 50 lakh rupees, 1 crore rupees, because the vendor know it's a very big company. And probably if I will raise a demand of, let's say, 1 crore rupees, probably I will end up getting 20 lakh, 10 lakh, 15 lakh, right? So in India, people used to do that. Now the question arises, how do I estimate whether it should be created as a provision or contingent liability? Of course, we need to look at whether the outflow is probable or not. So how will we ascertain that? So we will ascertain with the help of our advocates, with the help of our legal counsel, that what are the chances that we will win the case. If he will say that there are high chances, more than 50% chances are there that we will win the case. It means the provision should not be recognized because the outflow is not probable. The obligation could be possible obligation, and hence contingent liability should be disclosed. But let's say, even if contingent liability is required to be disclosed with some number, or even if a provision is required to be recognized, how this number should be arrived at? So then we will ask to my legal counsel that what should be the best estimate if, let's say, tomorrow I lose the case. What is the amount which we may be obligated to pay? What is the amount? So then our legal counsel says that in the worst case scenario, for example, we will lose the case. So of course he has told about this. He has filed a suit for defamation of 50 lakh rupees, and this vendor is a very small vendor, and this vendor is having a limited set of customer, and there is no point of defamation in that. So probably we may compensate him to the extent of the loss incurred by him, for example, right? So legal counsel is saying that don't worry, the best estimate for this case is not more than 5 to 10 lakh rupees. So we are just on a higher side, let's say on an ultra conservative side, we are creating a provision of 10 lakh rupees, right? That we may end up paying 10 lakh rupees. So my dear friends, my dear students, the moral of the story is how these things are running practically. In examination, things are very simple, I would say, because these things may be given in the paper. But in my practical life, in our practical life, and you will become a chartered accountant, and you will work in the financial reporting domain of any company. So things will play like this. Things will go like this, right? In a practical environment. Okay. I hope you guys have understood. I hope you guys have understood. Yeah. Okay. Very good. Very good. Is it clear? So provision is required. we recognize on the basis of best estimate. While estimating the best estimate, for example, you are creating a provision for asset retirement obligation, right? Let me take an example of provision for gratuity. While calculating provision for gratuity, what you guys are taken? What you guys are taking? Escalation rate, salary escalation, attrition rate, right? And you are also taking mortality rate. That as per LIC census, what is the mortality rate? You are taking all these assumptions for calculating the future value of gratuity and then discounting it to the present value. Although provision for employee related provisions are not covered in this standard, employee related provisions are covered in Ind AS 19. Now, friends, let me come to the ARO again. For example, Reliance Industries. Reliance Industries has a oil wells in Krishna Godavari basin, KG basin, right? They have a, let's say, contract with the government that you have to restore this seabed after 30 years, right? So they have the oil rigs, oil wells in the sea. So they have to restore that after 30 years, after 50 years. So they have a very big obligation in their balance sheet with respect to asset retirement obligation. Now, how do they estimate that? First of all, again, sorry, if they have, let's say, for the current period, in the current period, let's say the obligation comes out at 10 lakh rupees. If I'll restore the same situation, same same property, plant and equipment, it will cost me, let's say, 10 lakh rupees. I know that in future, since the technologies are also coming, so I know that in future, so today why it is taking 10 lakh rupees? Today it is taking 10 lakh rupees because of the lot of manual intervention, right? Manual intervention. And hence the cost is high. But after 30 years, after 40 years, the technology which is coming in, I know that I will end up saving a cost of to the tune of 30 to 40%, right? So this cost will be this cost will be lower by 30 to 40%. I'll take a classic example here, right? If I talk about 30, 40 years back or 50 years back, if someone has to construct a multi-story building, let's say, right? So the labor used to carry the bricks on the head load, right? The labor used to carry the bricks on their head load, on their head. Nowadays, since last 2-3 decades, the technologies are so fast and there are a lot of heavy equipments which carry the bricks to 10th floor, 9th floor, 7th floor, right? 12th floor, 30th floor. Okay. So basically they are carrying 100 bricks, 200 bricks, in one go. But if there is a labor who has to take these 100 bricks to the 10th floor, probably he will take, half a day or he will take 1 day, right? Going to up and coming down and then carrying these bricks. It will carry a huge cost, right? So friends, if in future the company is certain that some technologies are going on or it will bring down some cost also, so that future technologies or that future impact should be taken while calculating the provision, right? But the standard says that if there are some residual due to expected disposal of asset, for example, when you do the dismantling, so of course you have to sell the scrap also, no? For example, if a person has bought a old house, so first he will demolish that house and then he will construct a new house. So when he will demolish that house, so of course he will sell those bricks and everything, no? He will sell that scrap. So even that scrap will give him some money, give him some revenue. So friends, standard says that whenever you are calculating best estimate, future recovery should not be taken into consideration, right? And we are also aware that the expenses has to be taken on a conservative basis, but the income should not be taken on the conservative basis until and unless it become virtually certain, because we are not aware that after 30 years we will be able to realize this money. Okay, so expected disposal of asset will not be considered. Expected disposal of asset in future should not be considered while calculating the provision, right guys? So I have given you so many examples and everything. Okay, let's move now the theoretical part. And what is the theoretical part? How do we estimate the provision? The standard says that the amount provided should be the best estimate at the end of the reporting period of the expenditure required to settle the obligation. Right? We discussed this, that at the end of the reporting period, what is the best estimate which is required to settle the obligation. Okay. As per Ind AS 37, best estimate means that an entity would rationally pay to settle the obligation at the end of the reporting period to transfer it to a third party at that time. Means the company, so best estimate means it is close to accurate. I can say that it is close to accurate as per the facts and circumstances at that point of time. Since it is an estimate, it keeps on changing also, right? If some new development has come, for example, today, the legal counsel are saying we have a high chances that we will win the case. The magistrate has been changed, and now the magistrate is taking this case in a different manner. So after few hearings, the legal counsels are saying we have a very less chances that we will win the case. It means earlier you have shown as a contingent liability. Now you will have to create a provision, right? Or even in the provision, you have to change the amount of provision as per the development in the case, right, guys? Since it is a best estimate, it may keep on changing on the basis of the facts and developments. The estimate of outcome and financial effect are determined by the judgment of the management of the entity, and of course, it is a case of a judgment. It is a case of an estimate, right? Estimate. Expected value method is used to measure provision where large population of items are involved. The obligation is estimated by weighing all possible outcome by their associated probabilities. Sir, what does it mean? Please confirm if the Excel file is visible to all of you. Please confirm. I hope my Excel file is visible, guys. Is it visible? Yes. Okay. Thanks. Now we are discussing measurement of provision. Okay. And we have discussed a lot about this. How to measure the provision. It is a best estimate, right? Provisions are required to be measured on the basis of best estimate. And best estimate needs to be calculated as per the expected value approach. What is expected value approach? What is expected value approach? Tell me. Expected value approach is nothing. It's a statistical approach. Statistics. You understand what is statistics? Statistical approach, right? You are using statistics in your MAFA also, financial management also, at a lot of places in financial reporting also, like in Ind AS 115, you are also using the statistics. Means probability. Expected value approach is nothing. It's a probability, right? It's a permutation and combination, I would say. It's a probability. What is meant by probability, right? How do you calculate the provision? I'll take an example. For example, if the company has given a warranty, right? The company is selling mobile phones and the company has given warranty for the mobile phones for 1 year, right? Now the company, this OnePlus, has sold 10,000 units of mobile phone. While selling this 10,000 units of mobile phone, first of all the 10,000 will not come for the repair, right? They are considering that if we are selling 10,000 phones, 5% phones will come to us as a repair. Means 50 phones will come to us as a repair. Okay. 500. If we are selling 10,000, 5% comes to 500. Okay. So if 500 phones will come to us as a repair, okay. So now I have to quantify what could be the cost of the repair. Okay. So few people will come to us as a, for a normal repair or a normal problem, for example, upgradation of software, okay, or some small problem. Few people will come for the problem relating to the screen. Now the company has to replace the entire screen and it is a very costly proposition, okay. So friends, now the company will estimate that all these 500 phones will not have a same kind of problem. Out of 500 phones, okay, so basically first of all it is 5%, and out of 5%, right, out of 5%, let's say 20% is a very minuscule repair where 0% cost will be there. It is hardly a matter of upgradation of software and things will become fine. 30% cases belongs to a very minor repair where hardly 1000 rupees of cost will be there for every mobile phone. Okay. 50% repair is a major repair where the company will end up, incurring, let's say, 5000 rupees per mobile phone. Right. So it means there are multiple outcome of an event. Okay. Multiple outcome. So if there is a large population involved, and in this large population is involved, you are working on 10,000 units. Okay. You are working on 10,000 units. Large population is involved. So friends, standard says that if the large population is involved and there is a multiple outcome of an event, then you have to apply probability weighted approach. What is the probability weighted approach? For example, in case of a warranty obligation, for example, let's say there are 50% chances that the minor repair would be there and the cost will be 20 lakh rupees. There are 30% chances that the major repair will be there and the cost is 40 lakh rupees. There are 20% chances that there will not be any repair and the cost is 0 rupees. What could be the amount of provision? In this case, the amount of provision would be 50% of 20 will be 50% of 20 lakhs comes out as 10 lakh. Okay. 50% of 20 will come out as 10 lakh. 30% of 40 will come out as 12 lakhs. 20% of 0 will come out at 0 lakhs. It means you have to create a provision of 22 lakhs, right? Provision of 22 lakhs. Okay. Clear? Is it clear? There are 50% chances that would be the minor repair. The total cost would be 20 lakhs. If the chances are 50%, 20 multiplied by 50. So the company has to create a provision on the basis of probability weighted approach, right? This probability weighted approach should be applicable in case of a large population where there is a multiple outcome of an event, right? Most likely approach. What is meant by most likely approach? Most likely approach is a binary approach. Yes, no. Binary approach. Yes, no. Okay. For example, in case of environmental cleanup, okay. So binary means either yes or no. Okay. So for example, why this, when this most likely approach will be applicable? The most likely approach will be applicable when there is a single event, when there is a limited population, there is a single event. For example, if there is some carbon emission or air pollution, water pollution or land pollution created by the company, and the company does not have any constructive obligation, the law is also not there. So, right, for example. So in this case, whether the company is liable to clean up the environment or the company is not liable to clean up the environment, right? So there is a binary outcome. Okay. Yes, the entity will make good the damages to the environment. No, the entity will not do, right? So in this case, it should not be no 30% chances entity will do, 40% chances government will do, 20% chances no one will do, right? It's not like that. In case of a single event, there should be a most likely approach. For example, in case of a legal claim, one case is going on, right? One case is going on. So whether we will win the case or whether we will lose the case. For example, I got this faulty mobile phone and the company does not want to replace this mobile phone. I have filed a case in the consumer court, right? The cost of the mobile phone is 1 lakh rupees. So whether I will end up paying 1 lakh rupees or I will not end up paying 1 lakh rupees, right? So there is not a multiple outcome of an event. There is not any multiple outcome of an event. But in case of a warranty, there is a multiple outcome of an event, right? And that's why in single events, most likely approach is required to be used. Is it clear? Is it clear? I hope it is clear to all of you guys. In examination, don't worry, this probability will be given to you in the question paper. Now let's discuss one of the case study from your institute study material also, which I have given here. Company A sells a product with 1 year warranty. Number of products sold during 2020 were 5 lakh. 5 lakh products sold. Cost to repair one item. Cost to repair one item. In case of minor defect, it is $20. In case of major defect, it is $60. What is the past statistics? No defect for 75% goods. It means if 5 lakh goods have been sold, right? No defect for 75%. 5 lakh multiplied by 75% multiplied by 0. There is no defect. If there is no defect, there will not be any provision. Minor defect for 20% goods. 5 lakh multiply by 20%. If there is a minor defect, probably per unit, per item, cost is $20, right? Major defect for 5% goods, 5 lakh multiply by 5% into, if there is a major defect, the cost will be $60. This total comes out as 100%, right? And this should be, what should be the provision for warranty cost? This should be the provision for warranty cost, right? Using the expected value approach. This expected value approach is known as a probability weighted approach. Five lakh multiply by 75% multiply by 0. 5 lakh multiply by 20% multiply by 20. 5 lakh multiply by 5% multiply by 60. So this comes out at 35 lakh. Right? Koshiki, is it clear to do? Is it clear to you? Rashmi, Smith, Sanjay, Viraj, Rahul, Pooja. Is it clear? Good. Yeah. Thanks, Rahul, for this nice feedback. Thank you so much. Guys, we have understood this probability weighted approach or most likely approach. In case of a large population where there's a multiple outcome of an event, right? And we have seen in this case, there could be a multiple outcome. Okay. In this case, you have to create a provision on the basis of probability weighted approach. In case of single events, you have to create a provision on the basis of most likely approach, right? Where the outcome is binary, means yes or no, 0 or 1. Okay. Present value we have discussed, right? Future events. Standard says that, now coming to the future events. Okay. So standard says that future event that may affect the amount required to settle an obligation shall be reflected in the amount of a provision where there is sufficient objective evidence that they will occur. Example, the effect of possible new legislation is taken into consideration in measuring an existing obligation when sufficient objective evidence exists that the legislation is virtually certain to be enacted. What does it mean? Friends, standard says that for example, the company has a manufacturing plant, right? And the company is having an acid factory. There was a river which was flowing near to the or adjacent to the factory. And this unhygienic, or I would say this acid emissions was also flowing into the river, and it is polluting the river and it is creating a water pollution. There was no established law in that particular state, and the company does not have any constructive obligation also. I mean to say, the company has never done this thing. The company does not have any published policies, right? So constructive obligation is more like a behavioral thing where the other party has got an expectation that this company will do this right thing. Okay. So now let's say Viraj is an auditor, and Viraj went to the for the audit of that company. Okay. So now Viraj is just what Viraj is doing. So Viraj is just walking around the factory, and Viraj asked the manager that, sir, you have a lot of carbon emission or acid emission in this river, right? And this is polluting the river, which is not a right thing. Okay. And tomorrow, if the government will ask you to clean this river, you have to. Right? So manager is asking Viraj, why you are telling this? Viraj said that, sir, I have seen in other states also. Right? Manager said, okay. So after 5 or 6 days, Viraj told the manager to create a provision to clean up this river. Right? Then manager said, why you are saying that we have to create a provision? We don't have any. I also have read the standard, and we don't have any legal obligation as well as constructive obligation. Viraj is saying, sir, you are operating in Chhattisgarh. Friends, I am just taking an example. Okay. Viraj is saying that, friends, Viraj is saying that, sir, you are operating in Chhattisgarh, and in Chhattisgarh, this policy has been drafted. Okay. The only thing is, it has not got the assent in the parliament, or let's say, or the final authority, but at the lower authority, it is confirmed, right? And there are high chances, there is a virtual certainty that this is going to be enacted. There is a virtual certainty that this is going to be enacted, right? This is going to be enacted. And hence, you have to consider future event in creating your provision. Future event means the future event, if there should be already a past event which have been occurred, since you have already polluted this river, right? And the policy or the law has been drafted. The only thing is, it requires the final approval, which has not come. But of course, if the final approval will come, of course, you will have a legal obligation, because this is coming as a retrospective. So friends, the standard is saying that if the future event, right, is likely to happen, if the future event is likely to happen, and which may affect the amount required to settle an obligation, it has to be taken in the consideration if the sufficient objective evidence are there that they will occur. Like Viraj is saying that at the lower level, it has already been approved. It only requires a final approval. In corporate, guys, what we are doing, let me tell you. For example, if there is an entry which is coming in for the accounting purposes, so I am just giving it to my team that let's say you need to check this, and you need to just confirm me. Okay, if it is okay, if you are saying okay, I'll approve it. Okay, so normally when the lower, at the person who is sitting at a lower level, or at the level below you, if they are approving you, you are approving that, right? Normally, in a normal scenario. So friends, in this case, it is virtually certain that this legislation is going to be enacted, because it is in favor of the communities also, societies also. And hence, in this case, this provision is required to be taken into consideration, right? Why I'm saying that, why there is a specific guidance given in this standard regarding the future event? Probably you may tell that, sir, there is a past event, but there is no present obligation, because either there is neither a legal obligation nor a constructive obligation. That is why standard has told you that in case of any future event which is virtually certain to be enacted, or virtually certain to be happened, the provision is required to be taken into the consideration, right? Expected disposal of assets. If you are just thinking that, if I'll create this provision, right, if I'll have some obligation, I will have some money from the disposal also. Standard says that no, nothing doing. So gains from the expected disposal of assets shall not be taken into account in measuring a provision, right? Is it clear, friends? Very good. Let's discuss this example of future event case study. Again, this case study is from Institute study material, right? Guys, if I'm not showing you the study material, does not mean that I am not taking an example from, or case studies or illustration from study material. These are the illustration or case studies from study material itself. X Chemical Limited, engaged in the chemical industry, causes environmental damage by dumping waste in the river near to its factory. It does not clean up because there is no environmental legislation requiring cleanup, and X Limited is causing damage for last 40 years. So guys, there is no environmental legislation, means no legal obligation. and X Limited is not cleaning up and it is dumping the waste for last 40 years. It means the constructive obligation is also not there. They do not have any published policy. Probably if they would have the published policy, the auditor may force him to create a provision. Okay, as per the compliance of the standard. As on 31st March 2002, the state legislature has passed a legislation requiring all polluting factories to clean up the river water already contaminated. The formal gazette notification of the law is pending. The only thing is the formal notification has not come, but the state legislature has already passed it. So how should X Chemical Limited deals with this situation? Tell me whether we need to create a provision or we should not create a provision in this case. It is virtually certain to be enacted. We have to create a provision. In this case, the obligating event is the contamination of water, right? This is the obligating event. And because of the virtual certainty of the legislation requiring cleanup of the factory, an outflow of resources is certain. It is possible to arrive at the best estimated cost for the cleanup activity, right? The only thing is it has to be measured the best estimate. What should be the best estimate to clean up the factory? So a provision should be recognized in the books of X Chemical Limited for 2001-2002, right? Is it clear? Is it clear, guys? Okay, now let's discuss about a reimbursement. We are discussing measurement of provision. In measurement of provision, we have discussed that the provision has to be created on the basis of the best estimate. We have discussed that provision has to be measured on the time, measured at present value. The time value of money is material. And we have also seen that the discounted value of provision will become the full value of provision if there is an interest cost will be there. If interest cost will be there, right? So if interest cost will be there, the interest cost will be there. The unwinding of provision will create an interest cost in the books of accounts. Then we talked about the future events. Okay. Then we talked about the expected disposal of assets. Okay. Understood? In the examination, while in examination, they will give you some facts that, for example, the company has installed a factory on the leasehold land, and the company is required to dismantle this factory after a period of 3 years. Okay. And the today's dismantling cost is 10 lakh rupees, and the current inflation is 7%, and it is expected to remain same for the next 3-4 years. Okay. So the question has given you the current restoration cost. The question has given you the expected inflation. The question has given you the expected inflation for 3-4 years, and the leasehold period is 3-4 years. It means you have to restore, you have to dismantle, you have to restore after a period of 3 years, let's say. And in the question, it is given that when the company will dismantle the factory, there will be a lot of scrap, and the company is expected to receive 5 lakh rupees from the sale of the scrap, right? So friends, if you have not read the standard carefully, probably you will assume that, oh, I am talking about my dismantling cost provision, right? So let's say today cost is 10 lakh rupees, right? So if I'll factor the inflation, it will comes out at, let's say, 25 lakh rupees at the end of 3 years. But I'll get 5 lakh rupees at the end of 3 years. So I should create a provision of 20 lakh, which is after 3 years, and 20 lakh rupees I have to discount it. 20 lakh rupees I have to discount it. Okay. So probably, and many students have made this kind of mistakes, right? But you have to remember that you cannot consider this expected disposal of assets until and unless it will become virtually certain. It will become certain. Okay. You cannot consider that expected income in creating a today's provision, right? So standard does not allow that. Please keep this fact into your mind while creating a provision, right? Is it clear? Clear, not clear, or clear? Koshiki is saying, sir, can we take inflation rate as a discount rate? Can we take? Koshiki, you tell me, please. If the inflation rate is 6%, let's say, what does it mean? Normally, your cost of living will inflated by 6%. So whatever you are purchasing in 100 rupees today, tomorrow you have to spend 106 rupees for the same satisfaction, for the same product, for the same outcome, right? For the same product. So your purchasing power will go down by 6%. That's all, right? Now you tell me, if the inflation is 6%, whether the bank will also demand you the interest rate of 6%? Or let's say, when you have to lend money to your friend, will you lend it 6%? Answer is no. In that case, you will not end up having any margin, na? In last year, you are also lending at 6%. Now again, you will lend at 6%. Answer is no. So this inflation rate should not be equivalent to discount rate. Okay. The discount rate is normally higher than the inflation rate. Understood? So in the question, discount rate will also be given. But what happened if the discount rate will not given in the question? In that case, if the discount rate is not given in the question and only inflation rate is given, then please put a sentence or put a line in the standard saying, sorry, not standard, in the question paper, in the answer, that in this question, the discount rate is not given. So we are assuming that this inflation rate is a discount rate. That's all, right? And you have to, you have to compound with, let's say 6% inflation, and you have to discount with 6% inflation, right? Sumit is asking, virtually certain means more than 50% chance. Answer is no, Sumit. Virtually certain means more than 95% chance, right? More than 50% up to 95% is a probability. It's a probable, right? It's a probable. Is it clear? Now let's discuss the reimbursement part. What is meant by reimbursement? Okay. What is meant by reimbursement? Friends, for example, A Limited is a dealer. A Limited is a dealer. Dealer of battery, right? And X Limited is a manufacturer. Battery. A Limited. So A Limited purchases goods from X Limited. A Limited sold to customers, the final customers, right? It reaches to the finally to the customers. Now, X to A to customers. Now, A Limited is giving a warranty to the customer, right? For this battery, A Limited is giving a warranty. And X Limited has a contract with A Limited that whatever warranty cost you will incur, I will reimburse you 90% of that, right? I will reimburse you 90% of that. And A Limited is giving a warranty to the customer. So friends, first of all, you tell me, if there's a problem with the customer will go to whom? The customer will go to the A Limited, right? The customer will go to the A Limited. And you must have seen in some product, the dealer says that the warranty is with the company and you have to visit the company service center. You should not come to me. In some product, the dealer says that you can come to me, right? I'll get it repaired. You must have seen that. You must have seen these two models, right? You must have seen these two models. Is it clear? You must have seen these two models. Yeah. Friend, A Limited has sold a goods worth 10 crore rupees. And A Limited is presuming that 10% will come to me as a warranty cost, as a repair cost. So 10 crore multiplied by 10% comes out at 1 crore. So A Limited has to create a provision of 1 crore rupees, right? But at the same time, A Limited will get the reimbursement from X Limited to the extent of 90%, means 90 lakh rupees. So friends, you tell me whether I should create a provision of 10 lakh rupees in the balance sheet, or I should create a provision of 1 crore rupees in the liability side and 90 lakh rupees in the asset side. You tell me what should be there. Standard says that in case of a reimbursement, if it is virtually certain, it is certain, na? If you are estimating that I will end up paying 1 crore rupees, you have a back-to-back contract of reimbursement. You will get 90 lakh rupees of reimbursement. So of course, you will get the reimbursement. It is virtually certain, right? But guys, in this case, A Limited has to create or recognize a full liability of 1 crore rupees in the balance sheet. Why? Because A Limited is liable towards the customers. And at the same time, A Limited will also recognize a reimbursement asset in the asset side, because this arrangement is between X Limited and A Limited, and the another arrangement is between the A Limited and the customers, right? And in this case, in the balance sheet, offsetting will not be there. Why? Because the reimbursement asset is with different party and the liability is with different party. Is it clear? And hence the parties are not same, and hence the offsetting of asset and liability will not be there. You have to recognize a provision liability in the balance sheet on the liability side with a gross amount, and you have to create a reimbursement asset on the asset side with a gross amount of 90 lakh rupees. Is it clear? Is it clear? Yeah. I hope it is clear to all of you, friends. But standard says that. Standard says that. So let's discuss this. Then I'll clarify some more things. In case of expenditure required to settle a provision, in case of expenditure required to settle a provision, is expected to be reimbursed by another party, the reimbursement shall be recognized only when and only when it is virtually certain that the reimbursement will be received if the entity settle the obligation, right? So it is virtually certain because it is backed by the contract also. The reimbursement shall be treated as a separate asset. The amount recognized for the reimbursement shall not exceed the amount of the provision, right? So why you are getting the reimbursement? Because you are getting the reimbursement, you have to incur some cost. You cannot say that 1 crore is my expected provision. You cannot say that 1 crore 10 lakh rupees is my expected reimbursement asset. The reimbursement asset should not be more than the amount of provision. Sir, what happens if tomorrow I am estimating 1 crore rupees, but tomorrow I will get the repair cost of 1 crore 20 lakh rupees. In that case, if 90% is the agreement, I'll get 1 lakh 8,000 rupees. So we will do it in the next year. We will do it tomorrow, not today, right? In that case, you will have a visibility that it's not 1, it's 120. And in that case, it's not 90, it's 18. Okay. Have you understood this? Is it clear? So reimbursement asset should not be more than the amount of provision. First, you have to estimate a provision, then you have to create a reimbursement asset. Chiki is asking by what name do we show in the asset side? You can show as a reimbursement of warranty cost, right? Or you can say that reimbursement asset, right? Simple reimbursement asset, or recoverable from manufacturers. You can also show it as a recoverable from manufacturers. When I'm talking about balance sheet, of course, it's in the notes to accounts. It's not on the face of the balance sheet, right? But what happens in the statement of profit and loss? So balance sheet we understood. So in the balance sheet we understood, right? In the balance sheet we understood that in the balance sheet liability will be there and asset will be there. But what about in the P&L? in the P&L, standard says that what is your net cost? In the P&L, what is your net cost? Your net cost is 1 crore minus 0.9 CR. Your net cost is 0.1 CR. So in the P&L, you can net it off because this is your net cost. This reimbursement can be netted off. But in the balance sheet, why it has to be shown separately? It has to be shown separately. Why? Because even if manufacturer will not pay you warranty cost, will not reimburse you warranty, you have to satisfy your customers, right? Because this is your contract with the customer, right? And you have to file a litigation towards your manufacturer to get this reimbursement asset, right? So that is why this liability has to be shown in full, because you are liable to pay, and this asset has to be shown in full. But in the P&L, you can net it off because your net cost is only 10 lakh rupees, not 1 crore rupees, right? Koshik is asking, sir, if it is certain regarding receipt on disposal of asset, then we will consider it in provision. Yes, Koshik, if it is virtually certain, then you have to consider it in provision. For example, the landlord is saying that the landlord who has given the land on a lease basis is saying that, don't worry, I will after 20 years, and in the contract he has written that after 20 years whatever scrap will be there, I will purchase at 20 lakh rupees, right? I will purchase at 20 lakh rupees, right? So in that case, you can while calculating the provision of AR, you can net it off by that amount at least, which is virtually certain. Why? Because it is backed by the contract. Is it clear? In that case, it is not expected. In that case, it becomes actual. Students, is it clear to all of you? Yes or no? Yes. Very good. Thanks, Pooja. Are you guys enjoying the session? We discussed about measurement of provision. We discussed about reimbursement. We discussed about future event. We discussed about expected disposal of asset. We discussed about the time value of money. We discussed about the accounting entries also for the time value of money, right? Right, guys? Now let's discuss the review of provision. What does it mean? For example, the court case is going on and you are aware that this court cases took long period of time, 5 years, 10 years, 15 years, 20 years, 8 years. So now you have created a provision and you have to review the provision. You have to review the provisions. Okay. Friends, what is meant by review of provision? Because since it is a best estimate and you have to do the reviews at the every reporting date. For example, a court case was going on. Your customer has filed a suit against you. And in the first year, when you are discussing with your legal counsel, they are saying, no, there is a high probability that we will win the case. You said, okay. So you haven't taken any provision. You have only disclosed a contingent liability. After 1 year, when the progress happens, your legal counsel is saying that, no, there is a very limited chances that we will win the case. Otherwise, there is a chances that we may lose this case, and it is probable that we may lose the case. Then you said, what is the amount of provision? He said 1 lakh rupees. You said, okay. Again, after 1 year, hearings happened. And now your lawyer is saying it's not 1 lakh rupees. Probably we may end up paying 1,50,000 rupees. You say, okay. You said, okay. So now you have created a provision of 1,50,000 rupees. At the end of the 4th year, with some positive development in the case, your counsel is saying that we may lose the case, but the compensation at the max should not be more than 50,000 rupees, right? Should not be more than 50,000 rupees. So in this case, you have to reverse 1 lakh rupees because you have created a provision of 1,50,000 and you have to keep the provision as 50,000 rupees. So friends, in this case, You have to review provision every year. You have to review provision every year. Okay. Since it is a best estimate, so the estimate may keep on changing due to the facts and development of that item or the product. Second example I will take here. So you are an automobile manufacturer, right? And again, you are also selling the car with the warranty. Let's take an example of Bihar or Jharkhand or UP or Odisha, right? Or let's say Chhattisgarh. So the company is operating in these states, and the company is getting a lot of warranty cost, a lot of service cost, a lot of repair cost, because the roads are not good. Okay. So the company used to create a provision for warranty or provision for service and repairs close to 5% of the sales or 10% of the sales. But since last 4-5 years, the condition of road were improved, right? And the company has seen that, and since these warranties are 3-4 years long warranty, right? The car warranties are not 1 year, it's close to 4 years. So now the company has seen that, water logging are not there, the roads have been improved, right? So now they are getting, very less, less service cost. Okay. Or the major repair has converted into minor repairs. So of course, due to this facts and development, they have to revisit the amount of the provision. They have to revisit the best estimate, and they have to change the estimate of the provision on a year by year basis. Is it clear? Is it clear? So Koshiki is asking, sir, provision is recognized in balance sheet and reimbursement is shown in notes? No. Koshiki, I am saying that when you show the balance sheet item breakups, you must be showing the balance sheet item breakup in the notes to accounts, na? In the schedule. So I'm talking about that. Right? I'm talking about that. Is it clear? For example, in the balance sheet, you are giving one line item as a, let's say, other financial asset or other current assets. But the breakup of other current asset like prepaid expenses, right? Like other expenses, you are giving in the other current asset, you are giving in the notes to accounts, which is in the form of the schedule. I'm talking about that. Okay. It's not like on the face of the balance sheet, you're writing recoverable from manufacturer, या फिर reimbursement asset. Viraj is asking, while doing provision for legal fees, TDS liabilities to be created. Viraj, here I am not talking about legal fees. I am talking about legal claims. If there is a, if you are creating a provision for advocates fees, it is not a provision, it is accrued expenses. You know that I have to pay 10,000 rupees or 50,000 rupees for every hearing to my lawyer. You know that, right? Clear? Is it clear or not clear? Clear? Okay. You have to review and adjust provision at each reporting date and adjust it to reflect the current best estimate on the basis of current development, current facts and circumstances. Okay. If the outflow is no longer probable, provision is required to be reversed. For example, due to the development of the case, now the legal counsel are saying we have a high chances to win this case. Now the case is in our favor. So you have to reverse the provision. If required, you can disclose the contingent liability till the time it is not getting settled. Provision shall only be used for the purpose for which they were originally recognized. For example, you have created a provision for legal claims, right? And now you are saying that no, this legal claim is not required. Now there is no provision is required for legal claim, but you have forgot to create a provision for asset retirement obligation. So you cannot adjust the provision for legal claims with the provision for ARO. You have to create a fresh provision for ARO and you have to reverse this provision for legal claims, right? Clear? Is it clear? Clear or not clear? Is it clear, guys? Yes or no? Yes, it is clear. Now let me show you the one let me show you the interest cost accounting entry also, which I have which I have explained you in the last class. Let me show you that accounting entry. In the last class, we have discussed one case study that future cash outflow is 10 lakh rupees. Discount rate is 6%. Time is 3 years. We have created a present value. How to create a present value? We have created a present value 10 lakh divided by 1 plus 6% to the power 3, and 89619 was the present value. And in the beginning of the year one, we have, or I would say that at when this provision was probable that it has to be recognized, the first entry was provision for compensation expenses account debit to provision for compensation payable. That at the end of the year, this opening is 839,619. We have created an interest with 6%. This closing become 889. This will become your opening balance. Then again, you have created an interest cost. This will become your closing balance. This will become your opening balance. Interest cost. This is your closing balance, right? So this is your closing numbers. Okay. Provision for compensation payable to cash. Provision for compensation payable to cash. Right. So this will be your last entry. Every year you have to unwind this provision by creating an interest cost and crediting the provision liability. So this was the entry which we have understood, right? Okay, guys, let's move to the next part and let me know if you have any query. I'll discuss that query, then I'll move to the next part. No, any query is there. I have answered all the queries which have been asked by the or raised by the participants. As of now, there is no open query, right? Okay. Now there are some specific guidance provided by Ind AS 37. Friends, now we have to discuss two important concepts, right? One, we have to discuss the concept of onerous contract. Second, we have to discuss the concept of restructuring provision, right? These two concepts which we are required to discuss now, right? So friends, it's 8:13 now. Let's have a 10 minutes break, and after break we will start these two concepts. Is it right? Let's have a 10 minutes break. Okay. Now we are discussing some specific guidance which is given in Ind AS 37, right? So there are two important aspects now. One is executory contract, onerous contract, and restructuring provisions, right? And let me look at if there is any query in the query box. No, there is no query. So let's move on. So we discussed the concept of executory contract at the start of this standard, right? In the last class. Executory contracts are those contracts under which neither party has performed any of its obligations, or both parties have partially performed their obligation to an equal extent. This standard does not apply to executory contracts unless they are onerous, right? So if neither party has performed any of its obligation, there is no provision. If both the parties have partially and equally performed their obligation, there is no additional provision which is required. But if there is executory contract, for example, I'm a company and I've entered into a contract with the customer that I have to supply some goods and you have to pay me the money for that. There is a contract that if I will not supply the goods by the delivery date, I have to pay a penalty of rupees of 5 lakh rupees. I haven't delivered the goods till the delivery date. Tell me, I haven't delivered and that customer has not paid me money as well. Is it an executory contract? Yes, this is an executory contract. Why? Because neither party has performed any of its obligation. But if in the contract a penalty clause was there, it was a binding agreement that I have to deliver it by the delivery date, scheduled date. If I'll not deliver by the scheduled date, I have to pay a penalty of 5 lakh rupees. The moment I have failed the delivery by the scheduled date, right? I have to create a provision. Why? Because this contract will become an onerous contract. What is meant by onerous contract? Onerous contract means loss making contract, right? Without delivering any goods, without getting any money, still I am obligated to pay 5 lakh rupees to my customer, right? And this contract will become an onerous contract. So if the executory contract are onerous contract, in that case, the company is required to create a provision for that. How it is required, we will discuss that, right? Yes, how it will be measured, we will be discussing that. What is a onerous contract? In a simple sense, in a simple language, these onerous contracts are loss making contract. These onerous contracts are loss making contract, right? Loss making contracts. These onerous contracts are loss making contracts. Okay. An onerous contract is a contract in which the unavoidable cost of meeting the obligation under the contract exceed the economic benefit expected to be received under it. What is a onerous contract? Onerous contract is those contract where the cost of meeting the obligation, is greater than cost of meeting the obligation, cost of meeting the obligation is greater than the benefits. Now I'll explain what does it mean. For example, I'm a company. I have entered into a contract with the customer that I will deliver this goods by, let's say, 31st March, okay, in this year, at a X rate. For example, at 10 rupees of at 10 rupees per product, right? And this contract is for 1 crore unit of 1 crore unit of product, 1 crore unit of item, and the total contract is for 10 crore rupees, right? So the customer will pay me 10 rupees per product, and the customer will pay me in totality 10 crore rupees of 10 crore rupees for the contract. Now, what happens? So if I talk about this contract, so I have already entered into a contract today that I will deliver the goods by 31st March. And if I'll not be able to deliver the goods by 31st March, I will have to pay a penalty of 5 lakh rupees, right? So friends, in this case, the cost of the product, the cost of the raw material has gone up, right? And there is no escalation clause. The cost of the raw material has gone up. There is no escalation clause. So earlier, the raw material which I as a company was importing from outside and using into the manufacturing of the finished product, which I have to deliver, was 6 rupees per product. 6 rupee was the raw material cost. 2 rupee is my production cost, production overheads, and 2 rupee is my margin, right? And that is why I have entered into a contract at the 10 rupees per product, right? The total value is 10 crore and the penalty is, let's say, 5 lakh rupees. So now this raw material cost has shoot up from 6 rupees to 9 rupee. 6 rupee to 9 rupee. Now, friends, what is my cost of this product? From 6 it become 9. 9 rupees my raw material cost and 2 rupees my production overheads. So what is the total cost of this product? Total cost to me for this product, 11 rupees. 11 rupees something which I have to incur to meet the obligation to deliver this product. And what I'll get? I'll get 10 rupees. I'll get 10 rupees, na? I have to spend 11. I'll get 10 rupees per product. It means I have to spend 11 crore and in return, I'll get 10 crore. Do you think I should have to deliver this? Do you think I have to deliver this? What is your view? I'll take a pause here. I hope you have understood this question. When I have entered into a contract, it was 6 rupees per raw material, 2 rupees my production overhead. But over the period of time, it will become 9 rupees. When I went to the buyer of the raw, when I went to the supplier of the raw material, he told me now the price has increased and it will cost you 9 rupees. So my total cost of inventory, my total cost of producing this product is 11 rupees. It means I have to expense 11 rupees per product, which is 11 crore. I'll get 10 crore. It means what is my loss? 1 crore. My loss is 1 crore. If I will meet this obligation, my loss is 1 crore. If I will not meet this obligation, what is my loss? Koshiki is saying that, sir, penalty is less than loss. Very good. So if I will meet this obligation, the loss is 1 crore. If I will not meet this obligation, what is my loss? It is 5 lakh rupees. It is 5 lakh rupees. So as a good professional, what you will suggest to your client? Not to deliver? Not to deliver and pay the penalty of 5 lakh rupees. Why to incur 1 crore rupees of loss? Right? Is it clear? But let's go back to the first proposition. The moment the prices has gone up and now I have to incur 11 crore, I'll get 10 crore. What kind of contract is this? What kind of contract is this? What kind of contract is this? This becomes your onerous contract. This becomes your onerous contract. Standard says that in case of onerous contract, you have to create a provision for that. Now, at what amount provision is required to be created? At what amount provision is required to be created? Standard says that provision is required to be created at lower of. Provision is required to be created at lower of what? Provision is required to be created at lower of what? Lower of cost of meeting the obligation. Yeah, cost of meeting the contract, obligation, oblique contract. Please write down. Provision is required to be recognized at lower of cost of meeting the contract and cost of exiting the contract. Exiting the contract, not meeting the contract. lower of cost of meeting the contract and cost of exiting the contract. So in this case, cost of meeting the contract is 1 crore. In this case, cost of exiting the contract is 5 lakh rupees. So the moment this contract become an onerous contract, the company is required to create a provision of rupees 5 lakh, right? The company is required to create a provision of rupees 5 lakh. On 31st March, the company is required to create a provision of rupees 5 lakh. Have you got it? Have you got it? Sumit is asking, onerous contract means always loss making. Yes, Sumit. The definition of onerous contract is a contract in which the unavoidable cost of meeting the obligation. Why it is saying that unavoidable? Because you have a binding agreement, right? If the contract is having a escalation clause, don't worry. Whatever price hike will be there, we will compensate you. Like nowadays, you know what builders are doing? Nowadays, builders, because these are 3 to 5 year contracts, so builder are saying, if there is a price hike in the raw material, if there is an inflation in the raw material for more than 5%, we will charge you extra, right? So up to 5%, they will say that we will bond. Why? Because their profitability is enough to cover this 5% inflation. They're already factoring this 5% inflation while giving you the price. But if it is beyond 5%, they have a contract, they have a clause in the contract that we will charge to the customer, right? So in this case, it is not an onerous contract. So onerous contract is a contract where the cost of meeting the obligation under the contract exceeds the benefit expected to be received under it. And you will be able to remember this example of 11 crore versus 10 crore. Right? Viraj is saying, if termination clause is in contract, analysis is to be done of loss. Of course, yes, Viraj. Of course, yes. Right? If there is a onerous contract, provision is required to be recognized. At what value? 1 crore or 5 lakh? Of course, as a businessman, what you will do? Of course, you will exit from the contract. You will not meet the contract, right? You will be happy to pay 5 lakh rupees. You will not be happy to incur 1 crore rupees of loss. First of all, you have to look at answer, Smith, to your question. Is the contract onerous in the first place? Answer is yes, in case the cost is greater than the benefit. In case the cost is greater than the benefit. The cost is greater than the benefit, right? The present obligation under the contract shall be recognized and measured as a provision. The present obligation under the contract shall be recognized and measured as a provision, right? Measured as a provision. Okay. Clear? And what is the measurement? Lower of what? Cost of terminating the contract, net cost of continuing the contract. So in my example, net cost of continuing the contract is 1 CR. Cost of terminating the contract is 5 lakh. So lower is 5 lakh. So onerous contract is required to be created. Provision is required to be created at 5 lakh. If contract can be terminated without paying penalty, then it is not onerous, right? There is no penalty clause. It is not onerous, right? Then what is onerous? For example, in my example, there was no any penalty clause. So of course, if the price has gone up, I'll not deliver. I'll not end up paying any cost. So of course, provision to aayega hi nahi, right? Is it clear? So example of onerous contract, once again, a company that operates profitably from its current leased building relocate its operation to a building but pays rent during the remaining 4-year lease term on the old building has an onerous contract. In this case, company is obligated to make payments but is no longer using the asset. For example, the company has taken a factory on a lease basis, a building on a lease basis for the period of 5 years. After 1 year, the company has relocated from this building to another building, and this building is lying vacant, right? And since the contract is non-cancelable contract, the lease is non-cancelable lease for the next 4 years. So in this case, the company is paying rental, but the company is not able to get any benefits. So this lease become an onerous lease, right? So in this case, the company has to create a expense and provision for the next 4 lease rentals as of now, right? So if The company will exit from the contract. What is the penalty? Penalty is the next 4-year lease rental. If the company will continue with the contract, what is the cost? Of course, next 4 lease rental, what is lower? So both are the same number, na? So company has to create a provision for the next 4-year lease rental, right? Sumit is saying if there is legal binding to deliver, then it has to be executed. Sumit, in that case, the contract itself says that doesn't matter. There is no penalty clause. So it has to be delivered. For example, in case of defense, for example, right? In case of defense, the Indian Defense Ministry has ordered some planes, fighter planes, right? And the cost has gone up, but the other entity has to supply to them, irrespective of the fact that the government will not compensate the entity. In that case, it is, of course, if you are saying that it has to be delivered, then what is the lower? Then this 5 lakh will not arise, na? So this 1 crore, it is not estimated. It is virtually certain that this loss has to be there. So you have to create a provision to the extent of 1 crore rupees, right? Is it clear? We are talking about that in real life scenario when this situation happens. For example, in this is a very clear cut example where the company has vacated that building and the company is paying rental, right? If you are not aware about the concept of onerous contract, what you will say? You will think that okay, in this case, the company will pay rent and the company will accrue the expense. But the point is, the company is not getting any benefit. And the moment the company is not getting any benefit, in that case, it becomes onerous and the entire cost has to be taken as a provision. In case of non-cancelable, both becomes equal, penalty and cost of meeting, right, Koshiki? In that case, what is the lower? Of course, both are equal. So to that extent, amount is required to be recognized. Viraj is saying as rent is paid monthly, then why to create provision? Viraj, the provision is required to be created because it is required by the standard, because it becomes an onerous contract, right? There is a present obligation. Answer is yes. There is a past event. You have entered into a non-cancelable lease contract, right? So even without getting any benefit, you have to pay a lease rental for the next 4 years. Sir, let's flip this example or let's expand this example. So still I have to, pay lease rental for the next 4 years and there is no use of this building to me. So I have decided to sublet this building. The per month rent is, or let's say the per year rent is 1 lakh rupees. So in the next 4 years, I have to pay 4 lakh rupees, right? So it's a non-cancelable lease contract and I'm getting a rent. And I decided to sublet and I'm only getting a rent of 50,000 rupees. I'm getting a rent of, let's say, 75,000 rupees every year from this building, right? So in the next 4 years, how much I am required to pay if I'll continue with the contract? How much I am required to pay? 1 lakh rupees per year into 4 lakh rupees, right? Since I will continue with this contract and I'll sublease. So what is the benefit I'm getting? 75,000 per year multiplied by 4 is equal to 3 lakh. So what is the cost? What is the net cost of continuing with the contract? 4 lakh rent minus 3 lakh receipt. 1 lakh rupees the net cost which I have to incur, right? Now, what is the cost of exiting the contract? If today I want to cancel this lease, what is the cost? I have to pay the remaining lease rentals as of now as a penalty, which is 4 lakh rupees. So 4 lakh rupees and 1 lakh rupees. What is lower, Viraj? The cost of exiting the contract and net cost of continuing with the contract. What is lower, 4 lakh or 1 lakh? 1 lakh is lower. So you have to create, since this contract become an onerous contract, you have to create a provision to the extent of 1 lakh rupees, right? Is it clear? The entry would be provision for onerous contract expense account debit to provision for onerous contract liability account, right? Yes. Let's discuss this case study. X Limited had entered into a non-cancelable contract with Y Limited to purchase 10,000 units of raw material at 50 rupees per unit at a contract price of rupees 5 lakh, 50 rupees per unit. As per the terms of the contract, X Limited would have to pay 60,000 to exit the contract. The exit penalty is 60,000 rupees. X Limited has discontinued manufacturing the product that you would use the said material. X Limited has identified a third party to whom it can sell the material at 45 rupees per unit. How should X Limited account for this transaction in its books of account in respect of the above contract? Friends, X Limited had entered into a non-cancelable contract with Y to purchase 10,000 unit of raw material at 50 per unit, right? So X Limited has already entered into a contract with Y Limited that X will purchase 10,000 units at the rate of 50 and the total value is 5 lakh rupees. And if X Limited will not accept the delivery, X Limited has to pay 60,000 rupees. So what is the cost of exiting from the contract? 60,000 rupees is the cost of termination, exiting from the contract. But if X Limited, and already X Limited has discontinued manufacturing the product in which this raw material is required to be used. So there is no use to this raw material, but X Limited had identified one party to whom it can sell this material, but he will only pay 45 rupees. So what is the cost of continuation with the contract? What is the cost of meeting the contract? X Limited has to pay 5 lakh rupees to the Y Limited, 50 rupees per unit, and X Limited will get 45 rupees per unit, means 4,50,000 rupees, right? So X Limited, if X Limited will accept the delivery and continue with the contract, meet the contract, X Limited will have to pay 50,000 rupees. But if X Limited will terminate this contract, X Limited will have to pay 60,000 rupees. So what is lower? Lower is 50,000 rupees. So it's better to take the delivery and sell it to the third party. So in this case, the moment this contract will become onerous contract, the company X Limited has to create a provision of 50,000 rupees, right? So in this case, what is the accounting entry? Provision for onerous contract expense account debit to provision liability account, to provision liability account, right? Is it clear? Viraj, I hope your question is also clear. Whatever you have asked, I hope I have been able to answer your query. Right, guys? Is it clear? Let me show you one practical example from Tata Motors Limited. Can you see the word file? Can you see this word file? Tata Motors Limited. Can you see this word file? If you look at this word file, so I have extracted the example of onerous contract from Tata Motors Limited, because in every company you will not get this onerous contract example. Right? That is why I have taken from Tata Motors Limited. Okay, you can see that what is the accounting policy of onerous contract given in the Tata Motors Limited. Accounting policy, provision for onerous contracts, right? A provision for onerous contract is recognized when the expected benefits to be derived by the company, from a contract are lower than the unavoidable cost of meeting its obligation under the contract. This is what we have read now. It is recognized when the company has entered into a binding legal agreement for the purchase of component from the supplier. So Tata Motor is entering into a binding legal agreement for purchasing some component for manufacturing of cars from the supplier that exceed the benefit from the expected use of the component. The company sells the finished goods using the component at a loss. Means the price has gone down, but the cost of the component has become high, right? And still Tata Motors, right? So for Tata Motors, this contract will become onerous contract, because if the price of the raw material become high, so of course they will have to incur a loss, right? And what disclosure they have made in the notes to accounts, let me show you. As at previous year ended 31st March 2021, the company had reassessed the onerous provision created, and based on the revised volume outlook, a reversal of provision aggregating to rupees 777 crores had been accounted. During the year ended 31st March 2021, The company had also made provision for estimated supplier claims of rupees 114 crores, which were under negotiation with the supplier. So probably Tata Motors has denied that taking the delivery of those product components, and now, as per the contract, Tata Motor is obligated to pay. So they have created a provision for onerous contract worth 114 crore rupees, right? So my objective is just to let you see that, let you know that practically the companies are creating accounting policy, giving the accounting policy for onerous contract, and the companies also providing the disclosure of onerous contract, right? Clear? Is it clear, friends? I hope it is clear to all of you. Let's come back to the PPT again. Is it clear to all of you? You can refer the annual report of Tata Motors Limited for financial year 2021 or 21-22. Okay. And there you will get the details of these provisions, onerous contract provision, accounting policy, and detail of onerous contract provision. Right? Shall I move forward? Okay. Friends, can you please respond on the chat box or on the query box? I'm not getting a response since last 5-6 minutes. Can you please respond if I'm audible? If you have been able to understand this thing? Okay, very good. Let's move on. Now let's come to the last part, last concept of India's 37, restructuring. What is meant by restructuring? What is meant by restructuring provision? Friends, restructuring means when the company has decided to restructure its operations, restructure its location, then something called as a restructuring comes into picture, right? It is little theoretical aspect. And from the examination perspective, you may expect some theoretical aspect from this restructuring provision concept. Right? First of all, when this restructuring will happen? In Ind AS 37, Ind AS 37 says that there are the following situations or events, there are the following examples which may fall under the definition of restructuring. For example, sale or termination of a line of business. Of sale or termination of a line of business. For example, if the company is selling a line of business, I'll take a hypothetical example once again. For example, Tata Motors Nexon is doing pretty well, Nexon car, right? And tomorrow they will decide that we will manufacture only private vehicles and we will not manufacture commercial vehicles, for example, right? So either they will sell the line of this commercial vehicle business to the other automobile manufacturer, or they will discontinue or terminate this commercial vehicle line of business. So yes, it is a example of restructuring. Whenever the companies are doing these kind of things, you remember the company, there is an impairment indicator also, sale or discontinuation of a line of business, right? So again, it will call for a restructuring also, restructuring provision also. If a company is selling or terminating a line of business, probably there would be some contract which become onerous. If there is a leasehold premises, if there are future commitment with the supplier, with the customers, probably there could be cost of redundancies. You have to retrench, you have to fire some employees and you have to end up paying the cost to them, right? So these kind of restructuring will happen, these kind of provisions will come into play, right? Whenever these kind of restructuring will happen. Okay, so one example could be sale or termination of a line of business, the closure of business location in a country or region, or the relocation of business activities from one country or one region to another. The company is discontinuing business in one part of the country or in one region, or The company is moving from one to another region, right? For example, the company was earlier having a plant in China. Now they are moving to India. Of course, there will be restructuring provision which is required, and restructuring provision will have a lot of provisions inside it, like cost of redundancies, like onerous contracts, right? So company has to see that. Cost of dismantling obligations or changes in management structure. Again, if the management structure is also changing, it is an indicator or it is an example of restructuring. I'm not saying that restructuring provision is required to be recognized, but yes, it is an example of restructuring. Okay, so these three are the example which is given in the standard, which is called as a restructuring. And whenever the restructuring is there, the provision is required to be recognized for that restructuring, right? Okay, now when this restructuring cost will be recognized as a provision, standard says that this restructuring is not a legal obligation kind of thing. It's a constructive obligation. When you have to create a provision for restructuring, for example, today I have decided. So today the board of directors have decided, let's discontinue this plant, right? Let's discontinue this plant. So we will start this discontinuation activity from the month of April, let's say. So in one room, so inside the room, if the board of director has decided to let's restructure, let's discontinue this plant, whether it will trigger for restructuring provision or it will trigger at some other time, the restructuring provisions, the restructuring will trigger only when the constructive obligation will be there. And when the constructive obligation will be there, the constructive obligation will be there when it is communicated. Either a policy has been released, either a press media has been released, press release have been released, or it is communicated to the aggrieved parties. Like it is communicated to the employees that we are shutting down this plant in the next year. You can start searching for other jobs. Or it is communicated to the supplier and the customer that we are discontinuing this plant, right? And you can the alternates. Okay. So whomsoever is the aggrieved party, if it is communicated to them, then only it will become a constructive obligation, right? And the restructuring provision is only required to be recognized when there is a constructive obligation. And when a constructive obligation will arise, a constructive obligation will arise only in two cases. One, only when the entity will meet two conditions. One, the entity will have a detailed formal plan of restructuring. You understood? So inside the room, the board of directors have framed a detailed formal plan of restructuring. Detailed formal plan of restructuring. The board of directors has formed a detailed formal plan of restructuring, right? What is a detailed formal plan? We will discuss. So means the board of directors are not only discussing let's discontinue, they have also created a plan, and this plan has communicated to the impacting parties. This plan has communicated to the impacting parties, right? So when this plan will be communicated to the impacting parties, it will create a valid expectation in the mind of the, it will create a valid expectation in the mind of the users. Okay, in the mind of the users, I mean to say in the mind of the stakeholders, right? That yes, this discontinuation will happen and probably it will impact us badly. Is it clear to all of you? This is a theoretical concept. You can expect a theoretical question from in the examination, that when a restructuring provision is required to be recognized, a restructuring provision is required to be recognized when there is a constructive obligation for restructuring. And when there is a constructive obligation, when the entity will meet two conditions, the entity will have a detailed formal plan of restructuring, and this plan has been communicated to the impacting parties, right? A board decision alone does not create a constructive obligation. Only the board has taken a decision inside the room will not create a constructive obligation until and unless it is communicated to the aggrieved parties, right? Now, sir, what is the component of the detailed plan? What is the component of the detailed formal plan? Detailed formal plan. Detailed formal plan. Detailed formal plan. What should be the component of this? The detailed formal plan should be the component. The detailed formal plan should have the clear cut. What are the business concerned? What are the business concerned? What are the concerned businesses with this restructuring, right? For example, my commercial vehicle business will be impacted. We will discontinue the commercial vehicle business, or we will discontinue these 5 line items, right? 5 product lines. What are the principal locations which are going to be affected, right? For example, with this decision, we will discontinue our Bhilwara plant, we will discontinue our Nasik plant, but other plant will remain as it is, will remain continue. Why? Because we will manufacture our private vehicles there, right? Third, function and number of employees who will be compensated, right? Of course, what will be the cost of redundancies? How much employees we are required to be compensated? How much functions we are required to be compensated? What are the expenditure undertaken for that, right? What are the steps which we have been already taking, and what is the expenditure for that? What is the timing of implementation of the plan? From when this discontinuation activity will get started, right? For example, we are saying that from the next year we will start this discontinuation, right? So these are the broad agenda of detailed formal plan. Like when you read the standard, what is the broad agenda? Objective and scope, recognition, measurement, subsequent recognition, end measurement, disclosure, right? These are the component of the detailed formal plan. Likewise, the component of detailed formal plan is what are the business concerned, principal location affected, function and number of employees who will be compensated, what are the expenditure undertaken, and what is the timing of implementation of plan is the component of the detailed formal plan, right? Is it clear? Is it clear, guys? Yes or no? Okay, very good. Second, restructuring cost. What is included and what is excluded? What is included and what is excluded? Friends, in restructuring cost, you are required to take into consideration only those costs which is relating to the restructuring. It means which is relating to the discontinuation of the business. The cost which is relating to the new business or the continuation of the business into the new location, that cost is not required to be taken into consideration as a restructuring provision. For example, the company is terminating the staff, right? The company is terminating for example, there are 100 employees and the company is terminating 60 employees and the company is relocating 40 employees, right? So the 40 employees who are getting relocated, the cost relating to the 40 employees should not be taken into consideration, but the cost of compensation which is given to the 60 employees has to be taken into the consideration. The cost relating to the 60 employees has to be taken into the consideration. So in restructuring provision, only those costs which is relating to the restructuring, which is relating to the discontinuation, has to be taken into the consideration. Second example, the employees, the company is moving from India to China. The company is relocating its plant from India to China, right? So now the company will relocate all the staffs to China, right? And the company will give the premises to all these employees in China. And the company is spending money on learning the Chinese language to their employees. So this giving the training to the employees for learning Chinese language is something which is relating to the continuation of the business, right? And hence it is not a restructuring cost. It is not a restructuring provision. So friends, the standard says that restructuring costs include the necessary, the expenditure necessary entailed by the restructuring, the expenditure necessary entailed by the restructuring. For example, if any supplier claim which has to be there due to restructuring, it has to be payable. There is a cost of redundancies, cost of a compensation given to employees. These are the necessary costs. These costs should not associated with the ongoing activity of the entity. If the cost which is getting to be incurred relating to the ongoing activity of the entity, this will not be taken into consideration as a restructuring cost. What is not included in the restructuring cost? Marketing cost is not included in the restructuring cost. Retraining or relocating continuing staff is not included in the restructuring cost. Investment in new system and distribution networks, for example, PepsiCo. So in the last year, PepsiCo has shifted its office from one location of Gurgaon to the another location of Gurgaon, right? And they have invested a huge amount in the new systems and in the new systems in that building, right? So friends, when PepsiCo has moved from one building to another building, right? They have relocated. So whatever they have invested in the new building, that is not considered as a restructuring provision. But whatever they have to pay as a relocating from that building, leaving that building, if some provisions are there which is related to the discontinuation of that building, that provision is required to be taken as a restructuring provision. I hope you guys have understood this concept, right? Is it clear whether this concept is clear? Yeah. Now let's discuss this case study, and this case study has been asked in one of the ICI financial reporting examination, right? And this kind of case study was also asked in GFRS paper also. X Limited has 3 manufacturing units situated in 3 different states of India. X Limited has 3 manufacturing units situated in 3 different states of India. The board of director of X Cement Limited, in their meeting held on 10th January 2011, decided to close down its operation in one particular state on account of environmental reasons. So the directors in their meeting on 10th January has decided to close down its operation in one state on account of environmental reason. So is it an example of restructuring? Yes. You remember what we have discussed. Restructuring is sale or termination of a line of business, closure of business location in a country or a region, right? Yes, it is a closure of business location in a country. A detailed formal plan for the shutting down the above unit was also formalized. And when restructuring provision is required, the restructuring provision is required when there is a constructive obligation is there. When constructive obligation will be there, when the entity will meet 2 conditions. What is the 2 condition? First, detailed formal plan has been prepared and this plan has been communicated to the impacting parties. So it is written that a detailed formal plan for shutting down the above unit was also formalized and agreed by the board in that meeting, which specifies the approximate number of employees who will be compensated and expenditure expected to be incurred on account of this discontinuation of business in a location. Date of implementation of plan has also been mentioned, that from which date it has to be started. And what is the component of detailed formal plan? Business concerned, location affected, number of employees who will be compensated, expenditure, timing of implementation of plan. All these things have been given. Meetings were also held. Second, so first, detailed formal plan has been prepared. Second, meeting were also held with customer, supplier, worker. So who will be compensated? Supplier will be impacted, customer will be impacted, employee will be impacted, right? And all the meetings have been conducted with these parties to communicate the features of the formal plan to close down the operation in the said state. And representative of all interested parties were present in those meetings. And representative of all interested parties were present in those meetings, right? So first, detailed formal plan have been prepared and formal communication has also been made. Do the action of the board created a constructive obligation that needs a provision for restructuring? Yes or no? You have to give the reason for your answer. So how will you answer this question? You will answer this question, first of all. You will answer that in the given question. The decision of discontinuing a plant in or operation in one of the state due to environmental reason is an example of restructuring as per or in accordance with Ind AS 37 provisions, contingent liability and contingent assets, right? Why? Because it is a discontinuation of an operation in a particular location or a region, right? So this is an example of a restructuring in terms of Ind AS 37. So when this restructuring will happen, the company has to see whether a provision is required, whether the provision is required to be recognized. So the provision for restructuring is required to be recognized only when the constructive obligation will be there as an obligating event. And for an obligation to become a constructive obligation, two conditions should be satisfied as per Ind AS 37. One, detailed formal plan has been prepared and this plan has been communicated or the communication has been made with the impacting parties. It has been communicated to the impacting parties. In the current case, the plan have been prepared and the formal communication has also been made, and hence this create a constructive obligation, and the company is required to create or recognize a restructuring provision as per the provisions given in Ind AS 37. Right? This is how you have to answer this question, right? Yes, this is how you need to answer this question. As per Ind AS 37, the condition prescribed are there should be detailed formal plan of restructuring. We should have raised the valid expectation in the mind of those affected that the entity would carry out the restructuring by announcing the main feature of the plan to restructure. So you don't have to write this kind of technical language. Just you have to write there should be a detailed formal plan of restructuring and the formal plan has been communicated to the impacting parties. That's all, right? So in this case, the board of directors have discussed and formalized a formal plan of winding up the operation in the above said state. This plan was communicated to the parties affected and created a valid expectation in their minds that X Cement Limited would go ahead with its plan to close down operation in that state. Thus, there is a constructive obligation that needs to be provided at the end of the year. Right? Clear? Is it clear? Perfect. Okay, very good. Friends, now let's come to the last part, which is disclosure. As far as disclosure is concerned, the provisions, right? The reconciliation of the provision is required to be given. And how the reconciliation of the provision is required to be given? What was the opening balance? What is the addition? Right? What is the deletion? What is the addition on account of or increase on account of interest cost? Right? And what is the closing balances? And in this reconciliation, the comparative reconciliation is not required. I'll show you the disclosure in one of the annual report, which is Hindalco Industries Limited. Please let me know if this Word file is visible. Please let me know if this Word file is visible. Yes. This Word file, in this Word file, I have pasted or extracted the provisions from Hindalco Industries Limited, the disclosure of provision from Hindalco Industries Limited. In this case, if you can see, in this case, you can see that in Hindalco Industries Limited, they have created a provision as per Ind AS 37 on account of this 5-6 item. Employee benefit. And employee benefits provision is covered under Ind AS 19, not 37. Asset retirement obligation. This provision is covered under Ind AS 37. Okay, the current Ind AS which we are reading. Environmental liability. It is also covered under Ind AS 37. Enterprise social commitment. The CSR provision is also covered under Ind AS 37. If there is unspent amount of CSR, the provision is required to be recognized for that. Okay. Legal cases. Again, I'm not talking about legal fees. I'm not talking about the lawyer fees. I am talking about the legal claims. It is again coming under the Ind AS 37. Renewable power obligation. It is again coming under the Ind AS 37 or other provisions, right? The other small provisions. So you can see that these are the amount which the company has taken in the balance sheet and what disclosure the company has given. The detail of provision movement are is under. The company has given the provisions movement. for all these provisions, not for Ind AS 19 provision, for Ind AS 37 provision. What was the opening balance? What is the provision made during the year? What is the opening balance? What is the provision made during the year? Additional provision. Some reclassification is there that company has done. Okay. Provision utilized during the year. So how much provision is utilized during the year? How much provision is reversed during the year? The provision which is no longer required have been reversed. Unwinding of discount. What is unwinding of discount? You are taking this provision at present value, right? And now you're unwinding so that it will become a full value, right? So you are charging interest cost. So this unwinding of discount will also lead to create a provision. For example, in the first case, in asset retirement obligation, this Hindalco Industries has an opening balance of 91 crores. They don't have any reversal, any addition, nothing, but they have a unwinding of discount. Why? Because this provision is at discounted value, at present value, right? So this is the disclosure which is required with the provisions, right? This is the disclosure which is required for the provision. Right, guys? I hope you got a comfort after looking at this disclosure from a listed company, Hindalco Industries Limited, right? Very good disclosure, I would say. And I want you guys to download the annual report of Hindalco Industries Limited for financial year 2021 and financial year 2021 and read the accounting policy relating to provisions, contingent liability and contingent asset, and also see the disclosure which I am showing you, right? The comparative reconciliation is not required, but this company has given the comparative disclosure as well, right? The company has given the comparative disclosure, but the comparative disclosure is not required. But the company has given that, right? Just for the sake of maintaining the consistency. Is it clear? And after that, the brief description of provision is also required. What is ARO? What is environmental liability provision? What is enterprise social commitment? What is legal claims? What is renewable power obligation? What are the other provisions, right? So what is the reversal of renewable power obligation provision? So the details has also been given in the notes to accounts, right? In the notes to accounts. I hope it is clear to all of you, right? I hope it is clear to all of you. So in case of provision for ARO, for example, opening balance, new provision, right? The provision reversed, the amount used, right? And then interest costs. So these are required to be given as a reconciliation in the disclosure, right? I've shown you Tata Motors Limited disclosure for Tata Motors Limited disclosure for onerous contract and the entire reconciliation of provisions with Hindalco Industries Limited. Sumit is saying provision need to be proportionate in case of restructuring. Answer is no, Sumit. It has to be created as one time. Right? Sir, relocating plant and machinery will be part of restructuring cost, but staff not. Relocating plant and machinery will not be form part of your restructuring cost, Sumit. Right? If you are taking this plant and machinery to other place, it is not your restructuring provision. Right? When the plant and machinery will be relocated, it will be your transportation cost or freight cost. Right? And the disclosure is required by description, timing, category. So this I have shown you in the disclosure of Hindalco Industries Limited, right? Let's discuss the difference between AS 29 versus Ind AS 37. So in accounting standard 29, this discounting was not there, right? But in March 2016, only the discounting was permitted for asset retirement obligation, right? But in Ind AS 37, whenever the effect of time value of money is material, discounting is required. But in IGAP, in accounting standard, discounting is not permitted except for decommissioning, restoration, and similar liabilities associated with PPE, right? Discounting is not permitted. Coming to the contingent asset, there are only two differences. One, in IGAP, in accounting standard 29, discounting is only required with respect to asset retirement obligation. Otherwise, for legal claims, for environmental liability, nothing, discounting is not allowed. But in Ind AS 37, for every provision, discounting is allowed if it is beyond 1 year. As far as contingent asset is concerned, in IGAP, in accounting standard, contingent asset are not required to be disclosed in the notes to accounts. but it is required to be disclosed in the director's report. But in Ind AS, it is required to be disclosed in the notes to accounts to the financial statement, right? Clear? So this is something which I have discussed today. So friends, let's have a Maggie time, means 2 minutes revision. Friends, we have started the standard provisions, contingent liability and contingent asset. And we said that this standard is applicable to all the provision where the other standard will not be applicable. Then we discussed what is meant by liability, what is meant by provision, what is contingent liability, what is contingent asset. We discussed that the provision is a liability of uncertain timing or amount, not end amount, or amount. Uncertain timing or amount, right? And then we discussed provision is required to be recognized when 3 conditions will be satisfied. And it is not or, it is and, it is all. First, there should be a present obligation due to legal or constructive obligation arising out of past event. Outflow can be reliably measured and outflow is probable. That is one. Second, we understood what is legal obligation, what is constructive obligation. So provision is required when 3 conditions will be satisfied. Present obligation arising out of past event, outflow is measurable, outflow is probable. If there is a present obligation out of past event, but either outflow is not measurable or outflow is not probable, then it will become a contingent liability. Or when it will become a contingent liability, when the obligation is not probable, it is possible. So when there is a possible obligation where the outcome is depending upon the happening or non-happening of some future event, then it is a contingent liability, and contingent liability is required to be disclosed in the notes to accounts. Then coming to the contingent asset is again a possible asset, the outcome of which is depending upon the happening or non-happening of some future event. And this contingent asset, when there is a chances for more than 50%, but up to 95%, then only contingent asset is required to be disclosed when it is probable. If it is virtually certain, it will become an asset. It is no more a contingent asset, right? Then we discussed when a provision is going to be, how a provision is going to be measured. So provision is going to be measured on the basis of best estimate. How to calculate the best estimate? You have to use the probabilities. You have to use the expected value approach for measuring the provision. Expected value approach could be the probability weighted approach in case of large outcomes, large population, or it could be a most likely approach in case of binary outcomes, single events, right? Then we discussed if the provision which is going to be settled after 1 year, time value of money is material, you have to discount the provision and measure the provision on the basis of present value. Then you have to unwind the discount and you have to create a finance cost, interest cost, and you have to credit the provision so that it will become a full value at the end of the year, right? Then we discussed in case of future events, when it is likely to be certain that yes, this future event will happen, so this provision is required to be recognized in case of like environmental legislation. If there is an expected disposal of asset, right? You are expecting, oh, after 20 years, if I'll dismantle, I'll sell the scrap also. You cannot take that amount until and unless it is backed by some contract, right? Next, we discussed review of provision, that provision are required to be reviewed at every year end, right? If it is required to be increased, it has to be increased. If it is required to be reversed, it has to be reversed. Whenever the provision is not recognized, not required, it has to be reversed, right? Or probably the outflow is not probable, it has to be reversed, right? The provision of one item cannot be adjusted with another item. For another item, provision is required to be recognized. For one item, provision is required to be reversed. Clear? Is it clear? Okay. So let's come to the next part. So coming to the next part. So basically this is about the review of provision. Coming to the reimbursement. If an entity who is obligated to pay some amount on account of provision is entitled for some reimbursement also from the third party. So in that case, the reimbursement has to be shown as a reimbursement asset. The liability has to be shown, provision has to be shown in the liability side at a full amount. But in the statement of P&L, you can net it off, right? If you want, you can net it off. Next, we discussed about the onerous contract. If there is an onerous contract, if a contract will become a loss-making contract due to the penalty clause, right? So it will become an onerous contract, and in case of onerous contract means the cost of obligation is greater than the benefit, right? It will become an onerous contract, and in case of onerous contract, the provision is required to be recognized. What is the amount of provision? the provision will be recognized at lower of cost of meeting the obligation, means cost of continuing with the contract and cost of exiting the contract. I have given you 2-3 examples with that. So after onerous contract, we discuss the restructuring provision. What is the restructuring provision? Sale of a business, discontinuation of business, discontinuation of product line, sale of a product line, right? So discontinuation of business in a location, in a country, in a region, management structure, these are the examples, right? So when a restructuring provision has to be recognized, restructuring provision has to be recognized when there is a detailed formal plan and this plan has been communicated to the impacting parties, right? When there's a constructive obligation, right? So what is a detailed formal plan? In the detailed formal plan, the business concerned should be there, the location affected should be there, the number of employees to be compensated should be there, the supplier and customer claims, if any, should be there, right? Should be there, right? These all things should be there, right? And what is the date of implementation of plan? Timing and implementation of plan should be there, right? So when it is formally communicated, it will become a constructive obligation and you're required to take a restructuring provision. Restructuring provision will include the amount which is necessary to be incurred on account of restructuring not related to the continuation of the business. For example, you are relocating machinery from this location to another location. So this is for the continuation of the business. The transportation cost is not a relocate, not a restructuring cost, right? Right. If you are giving training to the employees, it is not a restructuring provision. It is a normal cost, right? So this should not be taken to the restructuring provision. So this is what we have discussed. As far as disclosure is concerned, the reconciliation is required. The nature and description of the provision is required. These are the disclosure in case of provision. I have shown you the Tata Motors Limited financial year 21-22 extract and the Hindalco Industries Limited financial year 2021 extract. I believe you have enjoyed this session. Let me look at the query box. If you have any query, I'll discuss that. Otherwise, I'll conclude this session. It's 9:30 now. Jay is asking, sir, why provision is made for restructuring? Are we not sure about amount or timing outflow? Jay, in case of restructuring, generally it will become an onerous contract. And that is why we are creating a provision for that. Just tell me one thing. Jay, if we are communicating to the employee that we will fire you after 3 months, do you think that employee will give his best? Do you think that employee will give his best if he is aware that I have to get fired after 3 months and the company is saying we'll compensate you for 6 months, don't worry, because probably you will not get the job after 3 months, right? So in this case, the cost of obligation will become greater than the benefits, right? And that is why at the time of restructuring, this restructuring provision is required to be recognized as a cost of redundancies. Is it clear, Jay? Friends, is it clear? Yeah. Any question? No? Okay, if there is no any question, let's conclude this session. Thank you very much. So we have covered this Ind AS 37 in 2 sessions, right? And for every concept, I have discussed a case study and examples to support, to make you guys understand that what is the concept. Just do the revision of these concepts and do all the questions from the institute study material. That is more than enough as far as examination preparation is concerned, right? Thank you so much, guys. Stay happy, stay blessed. Bye bye. Take care.